There are three types of people in the world of investing. There are the intelligent, the unintelligent, and the intelligent who go broke. The unintelligent go broke for obvious reasons. They chase fads, they don't do their research, they treat the stock market like a casino table in Las Vegas. Their financial demise is a tragedy, but it is not a mystery. The intelligent, on the other hand, the ones who do the work, who understand discounted cash flows, who can read a balance sheet and spot a competitive moat from a mile away. They build fortunes. They harness the eighth wonder of the world, compound interest, and they ride it to a state of complete financial freedom. But it's that third category, the intelligent who go broke, that presents the real puzzle, the true cautionary tale. How can someone who knows all the rules, who has all the tools, who possesses a high IQ and a strong work ethic, end up with nothing? How can brilliance lead to bankruptcy? For over half a century, one man has been thinking about this question more deeply than perhaps anyone else. He has seen brilliant minds, Nobel laureates even, with computational power that could simulate the birth of the universe, build financial machines of unimaginable complexity, only to see them vaporized in a matter of weeks. He has seen savvy real estate tycoons and whip-smart traders build leveraged empires that gleamed in the sun, only to crumble into dust at the first sign of a storm. And through it all, he has held fast to a single, simple, almost deceptively plain principle, a rule so fundamental that it forms the bedrock of his entire multi-hundred-billion-dollar empire, yet so often ignored in the manic rush for quick riches. That man is Warren Buffett, and his principle is the final promise he makes to himself and his shareholders. You should never, ever invest with borrowed money. This isn't a suggestion, it's not a guideline. To Buffett, it is an iron law. Because leverage, the act of borrowing money to amplify your investment bets, is the only thing on earth that can force a smart person into ruin. It is the only mechanism that can take a sound investment thesis, a temporary market downturn, and a brilliant mind, and combine them into a permanent, catastrophic portfolio-wiping loss. It is the kryptonite for the intelligent investor. Without leverage, you can be wrong about a company, and you lose some money. You can suffer through a brutal bear market, and you experience a paper loss. You can even make a series of boneheaded mistakes, and you will set back your goals for financial independence. But you will likely survive. You will live to fight another day. Your capital may be diminished, but it is not extinguished. With leverage, the entire game changes. With leverage, a temporary price fluctuation can trigger a margin call, a non-negotiable demand from your broker to either deposit more cash or sell your assets immediately to cover your loan. Suddenly, you are no longer in control. Your long-term strategy is irrelevant. The fundamental value of the companies you own is meaningless. The only thing that matters is the price on the screen right now, at this exact second. You are forced to sell your best assets at the worst possible time, turning a recoverable dip into a terminal disaster. Leverage strips you of your greatest asset as an investor, the ability to wait. It puts a ticking clock on your decisions and hands the detonator to the whims of the market. This is not a theoretical discussion. This is the most practical and vital lesson in the entire universe of personal finance and wealth management. By embracing this one rule, by committing to a path of absolute solvency, you do more than just improve your risk management. You undergo a complete financial transformation. You adopt a mindset of indestructible resilience. You guarantee, with 100% certainty, that you can never be forced out of a good investment by the madness of the crowd. You grant yourself the power to ride out any storm, to watch with calm detachment as others panic, and to allow the magnificent engine of compounding to do its work over years and decades, building you a fortress of true, lasting wealth. This is the story of that one rule. It is the blueprint for not just succeeding in the market, but for ensuring you can never be removed from the game. It is the final promise every investor must make to themselves if they truly seek financial freedom. To truly understand the depth of Warren Buffett's conviction against leverage, we must first travel back in time, not to a moment of crisis, but to the very beginning of his legendary career. We're in Omaha, Nebraska in the mid-1950s. A young, fiercely ambitious Buffett has returned from New York after studying under his mentor, the father of value investing, Benjamin Graham. He decides to start his own investment firm, the Buffett Partnerships. He gathers money from family, friends, and local doctors, anyone who would trust this nerdy, energetic young man with their savings. He set up a fee structure that was unheard of at the time. He took no management fee, only a quarter of the profits above a 6% annual return. He only made money if his partners made money first. This structure aligned his interests perfectly with his investors, but it also put immense pressure on him to perform. In these early days, the partnerships were wildly successful. Buffett was a master capital allocator, finding obscure, undervalued companies and making concentrated bets that paid off handsomely. His partners were thrilled. As the money grew, however, so did a certain temptation. Some of his partners, savvy businessmen in their own right, came to him with a proposition that on the surface seemed incredibly logical. They said, "Warren, you're brilliant. Your returns are phenomenal. Why are we not using leverage? We could go to the bank, borrow money at 4 or 5%, and invest it using your strategy that's making us 20 or 30%. We could amplify our gains, get richer faster. It's simple arithmetic." This is the siren song of leverage. It's mathematically seductive. And for a young man trying to build a name for himself, the pressure to juice his returns and grow his assets under management would have been immense. But Buffett's response was immediate and absolute. He refused. He explained to his partners in no uncertain terms that they would never, under any circumstances, borrow money to buy stocks. He told them, "My partner Charlie and I, we've operated on what we call the Noah principle. Predicting rain doesn't count, building arks does." For him, avoiding leverage was building the ark. He knew that even if he were right 99 times out of 100, that one time the market went violently against him, a leveraged position could wipe out everything they had built. It could turn all his brilliant past decisions into a single, tragic footnote. He was willing to look foolish by earning lower returns in a bull market in exchange for the absolute certainty that he would never be wiped out in a bear market. This decision, made in his 20s, was not just a tactical choice, it was the foundational philosophy upon which the entire Berkshire Hathaway empire would eventually be built. Now let's contrast that foundational anecdote with another, far more famous story that serves as its perfect, tragic counterpoint. Fast forward 40 years to the mid-1990s. A hedge fund named Long-Term Capital Management, or LTCM, is the undisputed king of the financial world. It wasn't run by cowboys. It was run by the supposed smartest guys in any room. Its partners included John Meriwether, the legendary head of bond trading at Salomon Brothers, and, most notably, 2 Nobel Prize-winning economists, Myron Scholes and Robert C. Merton, the creators of the Black-Scholes model for pricing options. Their strategy was to use complex quantitative models to find tiny pricing discrepancies in global bond markets, what they called arbitrage opportunities, and then use massive amounts of leverage to turn these fractions of a penny into billions of dollars. Their pedigree was impeccable. Their models were genius. For a few years it worked like magic. They generated returns of over 40% per year, and investors from all over the world begged to give them money. At its peak, LTCM had about $5 billion in equity, but through the magic of leverage, it controlled over $125 billion in assets. Even that number is misleading. The real exposure was in their derivatives positions, which had a notional value of over $1.25 trillion. They were leveraged about 25 to 1 on their assets, and over 250 to 1 on their equity. They had built the most sophisticated financial machine the world had ever seen, but it was a machine balanced on the head of a pin. Their models told them that the market events that could cause them to lose significant money were so statistically improbable they would only happen once in many millennia. They had convinced themselves that they had essentially eliminated risk, but in the summer of 1998, the improbable happened. Russia defaulted on its government debt. and a subsequent flight to safety and liquidity caused all of their carefully calibrated arbitrage trades to go haywire all at once. The tiny discrepancies they were exploiting suddenly widened into gaping chasms. Their models broke. And because of their extreme leverage, every small loss was magnified into a catastrophic one. They started getting margin calls. They were forced to sell assets into a panicked market, which only drove prices lower, which triggered more margin calls. It was a death spiral. In a matter of weeks, the fund lost over $4.6 billion and was on the brink of a collapse so massive that the Federal Reserve feared it could take down the entire global financial system. The Fed had to orchestrate a $3.6 billion bailout from a consortium of Wall Street banks to unwind the positions and prevent a total meltdown. The smartest guys in the room, the Nobel laureates, had been wiped out. Not because their trades were stupid. In a normal world, they were brilliant. They were wiped out for one reason and one reason only. They were drowning in leverage. The psychological principle that underpins this entire dynamic is a potent cocktail of two of the most powerful cognitive biases that affect human decision-making: overconfidence bias and myopia. Overconfidence is the tendency for people to have an unwarranted faith in their own abilities, judgments, and predictions. In the world of investing, this is rocket fuel for disastrous decisions. When an investor has a string of successes, their brain starts to release dopamine. They begin to attribute their success not to a favorable market or luck, but to their own unique genius. They start to believe they have a special insight, that they can see the future more clearly than others. This was the core disease at LTCM. The Nobel Prizes on their walls were a constant reinforcement of their own intellectual superiority. They believed their models were so perfect that they couldn't fail. The average retail investor experiences a milder form of this. They pick a few winning stocks, and suddenly they feel like the next Warren Buffett. They think, I'm good at this. If I just had more capital, I could really make some serious money. And the easiest way to get more capital is leverage. Overconfidence whispers in your ear that you can handle the risk, that you'll be able to get out before things go bad, that you're smarter than the people who get wiped out. This is compounded by the second bias, myopia, specifically a form known as myopic loss aversion. In a broader sense, myopia is the tendency to focus on the short term while ignoring the long term. When an investor looks at leverage, they myopically focus on the potential upside. They calculate how much faster their portfolio will grow if the stock goes up 20%. They see the accelerated path to wealth, the shortcut to financial freedom. This near-term best-case scenario becomes incredibly vivid and emotionally appealing in their mind. The potential long-term worst-case scenario, total and complete ruin, is a distant, abstract concept. It feels theoretical, like a plane crash. You know it happens, but you never think it will happen to you. This is the same reason people take out payday loans at exorbitant interest rates. The immediate need for cash today overwhelms the rational calculation of the crippling cost tomorrow. Leverage offers an immediate, amplified gain, and our myopic brains are wired to crave that immediate reward, underweighting the catastrophic but less immediate risk of a margin call. Buffett's genius is in his ability to completely invert this. He is obsessively focused on the long-term worst-case scenario. He doesn't ask, how much can I make? He asks, how can I guarantee I will never be forced into a position where I can lose everything? By focusing on permanent avoidance of ruin, he renders the short-term temptation of leverage completely powerless. So how do we translate this principle into a practical, actionable blueprint for our own financial lives? We can call this mental model the fortress of solvency. It's a step-by-step process to ensure you are never the forced seller, that your financial life is built on a bedrock of stone, not sand. Step 1 is to calculate your personal solvency ratio. This is a very simple but incredibly powerful metric. On one side, you list all of your investable assets that are owned outright: your stocks, your bonds, your index funds, any cash you have in savings. This does not include the equity in your primary residence, as that is not a liquid investable asset. On the other side, you list all of your investment-related debts. This is primarily margin loans, but it could also include personal loans you took out specifically to invest. Divide your outright owned assets by your investment debts. If you have no investment debt, your ratio is infinite. You are perfectly solvent. If you have $100,000 in stocks and a $20,000 margin loan, your ratio is 5:1. The goal is to make this ratio infinite. Your first action item is to create a plan to pay off any and all investment leverage, to get to a state of zero margin. This is your non-negotiable first step towards building the fortress. Step 2 is the market crash stress test. Once you are free of investment debt, you need to test the psychological and financial stability of your fortress. Imagine, tonight, that the market opens down 50%. A black swan event has occurred. Your $200,000 portfolio is now worth $100,000. Now, ask yourself a series of brutally honest questions. Does this event trigger any other financial crisis in my life? Because I lost my job in the ensuing recession, do I now need to sell my stocks at this 50% loss just to pay my mortgage? Does this psychological shock cause me to panic and liquidate everything, locking in the loss? If the answer to any of these questions is yes, your fortress is not yet strong enough. This leads to Step 3. Step 3 is building your sleep at night fund. This is a dedicated cash reserve, separate from your regular emergency fund, whose sole purpose is to provide psychological and financial stability during a market panic. The size of this fund is personal, but a good starting point is enough to cover 6 to 12 months of essential living expenses. This cash is your buffer. It is the moat around your fortress. When the market crashes 50%, you look at your sleep at night fund and you say, "I am fine. My family is safe. My bills are paid. I do not need to touch my investments. I can afford to wait." This fund short-circuits the panic response. It severs the link between a stock market crisis and a personal financial crisis. This is what gives you the power to hold on, and even better, to become a buyer when everyone else is a forced seller. By implementing these 3 steps, achieving infinite personal solvency, passing the stress test, and building your moat of cash, you have operationalized Buffett's core principle. You have made ruin impossible. Now, to fully appreciate the wisdom of this path, we must examine its opposite, the antithesis, the path walked by the 99%. This is the path of the margin-fueled gambler. Let's create a character. We'll call him Tom. Tom is smart. He's an engineer, he's good with numbers, and he's been diligently saving and investing in a low-cost index fund for years. He's built up a nice portfolio of $100,000. But it's been slow. He reads stories online about people making fortunes overnight in tech stocks and crypto. He feels like he's missing out. His brokerage account constantly flashes a notification. "You're approved for a margin account. Unlock the power of your portfolio." One day he clicks it. He sees that he can borrow up to $100,000 against his existing portfolio. Suddenly, he feels powerful. He's not just a $100,000 investor anymore. He's a $200,000 player. He finds a hot tech stock that everyone is talking about. The story is compelling, the growth seems unstoppable. He takes the plunge. He uses his entire $100,000 in margin to buy the stock. For a few weeks, it works. The stock goes up 10%. His portfolio value, which would have been $110,000, is now $220,000. $110,000 of his original portfolio, plus $110,000 from the new stock, minus his loan. His net worth has jumped by $10,000 almost instantly. The dopamine hits are incredible. He feels like a genius. He has found the cheat code. This is the path to rapid wealth management and true financial freedom. Then, the market turns. Some unexpected bad news comes out. A bad earnings report, a regulatory threat. The hot stock begins to fall. In 1 week, it drops 30%. Tom's $100,000 margin investment is now worth only $70,000. His total portfolio value is his original $100,000, which we'll assume was flat for simplicity, plus the $70,000, for a total of $170,000. But he still owes the broker the full $100,000 he borrowed. His net equity is now only $70,000. He has lost $30,000 of his own money, a 30% loss on his original capital, from a stock that only fell 30%. But it's about to get much worse. His broker's risk management system flags his account, the equity in his account, $70,000, as a percentage of his total holdings, $170,000, is getting too low. He receives the email that every leveraged investor dreads, the margin call. The email says he must deposit $15,000 in cash immediately, or they will begin liquidating his positions to cover the loan. Tom doesn't have $15,000 in cash. He's fully invested. He's forced to sell. But he can't just sell the losing stock. The broker often sells the most liquid assets first, which might be his safe, reliable index fund, the very foundation of his original portfolio. So the broker sells off a chunk of his index fund at a loss to pay down the margin loan. The next day, the hot tech stock falls another 10%. He gets another margin call. More of his portfolio is forcibly sold. This is the cascade. It is a feedback loop from hell. Within a few weeks, a market correction that should have been a temporary, survivable drawdown has completely gutted his portfolio. He may be left with just $20,000 or $30,000 of his original $100,000. He wasn't just wrong about a stock. He was financially ruined. He reset his decade-long journey of saving and investing back to zero because he fell for the siren song of leverage. The direct financial connection here is the brutal, unforgiving mathematics of the margin call cascade. Let's make this crystal clear. When you invest without leverage, your potential loss is capped at 100%. If you invest $10,000 in a stock and the company goes bankrupt, you lose $10,000. It's painful, but it's finite. When you introduce leverage, this symmetry is destroyed. Let's use a standard Reg T margin account, which allows you to borrow up to 50% of the purchase price. You have $50,000 in cash and you decide to buy $100,000 worth of a stock, borrowing the other $50,000 from your broker. Your equity is $50,000. The total value of your investment is $100,000. Now let's say the stock drops by 25%. The total value of your holdings is now $75,000. But you still owe the broker the full $50,000. So your personal equity in the position is now just $25,000, $75,000 in assets, $50,000 loan. The stock only fell 25%, but your personal capital has been cut in half, a 50% loss. This is the amplification effect in reverse. But it's the margin call that turns this amplified loss into a catastrophe. Most brokers have a, quote, maintenance margin requirement, often around 30%. This means your equity must always be at least 30% of the total value of your holdings. In our example, the value of your holdings is $75,000. 30% of that is $22,500. Your current equity is $25,000, so you are just barely above the maintenance margin. You're safe for now, but you're sweating. Let's say the stock drops another 10%, down to $67,500. Your loan is still $50,000. Your equity is now just $17,500. The maintenance margin required is 30% of $67,500, which is $20,250. Your equity of $17,500 is now below the required maintenance margin. Boom, margin call. The broker demands you add $2,750 in cash to get back to the required level. If you can't, they start selling. And they don't ask your permission. They sell whatever they need to sell, at the current market price, to protect their loan. This forced selling at the market bottom is the mechanism that turns a theoretical paper loss into a very real, permanent loss of capital. It prevents you from ever participating in the eventual recovery. A 35% drop in a stock price resulted in a forced liquidation and a potential 100% loss of your initial investment, depending on where the broker sells. This is how leverage breaks the fundamental laws of long-term investing. It ensures that you buy high on emotion and are forced to sell low on a technicality. It is the most efficient wealth destruction tool ever invented for the intelligent but overconfident investor. One of the most insidious aspects of leverage is how it perverts your relationship with time. For a true long-term investor, time is their single greatest asset. It is the runway upon which the airplane of compound interest takes off and ascends to the heavens. The longer you can remain invested in great businesses, the more powerful the geometric progression of growth becomes. Albert Einstein allegedly called compound interest the eighth wonder of the world, saying, "He who understands it, earns it. He who doesn't, pays it." Leverage forces you to pay it. It fundamentally corrupts the process of compounding by introducing a ticking clock, a fuse that can be lit at any moment by market volatility, threatening to blow up your entire financial future. To see this principle in action, we need only look at one of Warren Buffett's most legendary investments, American Express. The year was 1963, and American Express was a blue-chip, respectable company, a core holding for conservative investors. But then, disaster struck. It was called the Salad Oil Scandal. A major customer of American Express's warehousing division, the Allied Crude Vegetable Oil Company run by a man named Tino DeAngelis, had perpetrated a massive fraud. DeAngelis had used American Express warehouse receipts as collateral to get huge loans from banks. The receipts certified that his warehouses were full of valuable salad oil. The problem was, the warehouses were mostly full of seawater, with just a thin layer of oil floating on top. When the fraud was discovered, Allied Crude went bankrupt, and the banks holding the now worthless warehouse receipts came after American Express, claiming they were liable. Wall Street panicked. The market couldn't figure out how big the potential liability was. Would it bankrupt the company? The stock, which had been trading at over $60 a share, plummeted to as low as $35. It was a bloodbath. Investors, gripped by fear and uncertainty, dumped the stock indiscriminately. This is where Buffett, then running his small partnership in Omaha, saw an opportunity. He didn't just look at the stock price. He did the hard work of an intelligent investor. He went to restaurants and banks in Omaha. He observed customers and businesses still using American Express credit cards and traveler's checks. He saw that the core business, the powerful consumer brand and payment system, was completely unaffected by the scandal in the warehousing division. He concluded that the fear was overblown and the company's intrinsic value was far, far higher than the current stock price. So he made an enormous bet. He invested 40% of his entire partnership's capital into American Express stock. It was a stunningly concentrated position. Had he been wrong, it would have been a major blow to his reputation and his partners' wealth. But here is the crucial element that made the entire bet possible. He had no leverage. He was using his partnership's permanent capital. Because he had no margin loan, no one could force him to sell. He could afford to be patient. He could wait for the market to come to its senses, no matter how long it took. In the months following his investment, the stock price continued to languish. Fear still ruled the day. A leveraged investor, facing mounting paper losses and pressure from their lender, would have been forced to capitulate. They would have sold at the bottom, turning Buffett's brilliant insight into their own personal financial ruin. But Buffett, free from the tyranny of a ticking clock, simply waited. And of course, he was proven right. Within a few years, the salad oil scandal faded, the company's true earnings power shone through, and the stock price soared. Buffett's partnership made a fortune. That single investment was a key moment in cementing his reputation and building the capital base that would eventually become Berkshire Hathaway. The lesson is profound. His analytical genius identified the opportunity, but it was his financial structure, his absolute refusal to use leverage, that allowed him to actually profit from it. Time was his ally, not his enemy. The underlying psychological principle at play here is a powerful bias known as hyperbolic discounting. This is a fancy term for a simple, universal human tendency. We have a strong preference for immediate rewards over larger, delayed rewards. If I offered you $100 today or $110 in a week, you'd likely take the $100 today, even though a 10% return in 1 week is an absurdly high rate of interest. The immediacy of the reward holds a powerful allure. Our brains are wired for instant gratification. This is a relic of our evolutionary past, where survival depended on seizing immediate opportunities for food and safety, not planning for a distant retirement. Leverage is the ultimate financial expression of hyperbolic discounting. It dangles the promise of a faster, more immediate reward right in front of your face. Why wait 30 years for your portfolio to compound into a fortune when you can use margin to potentially get there in 5 or 10 years? The leveraged path promises a steeper, quicker ascent to the summit of financial freedom. Our brains see this immediate potential for amplified gains, and we heavily discount the value of the slower, more certain, but far-off reward of traditional compounding. We also discount the distant, abstract risk of ruin. The promise of more money now overwhelms the rational assessment of a much higher probability of having much more money later. Buffett's entire philosophy is a rebellion against this innate human flaw. He is a master of delayed gratification. He is perfectly content to let his capital compound at a reasonable rate for an extremely long period of time because he understands that the true power of the exponential curve is unleashed in the later years. He is playing a game that is measured in decades, not trading quarters. By refusing leverage, he is consciously choosing the larger, delayed reward over the smaller, immediate one. He is choosing certainty and survival over speed and speculation. This is an incredibly difficult mindset to adopt because it requires overriding a deeply ingrained psychological impulse. But it is precisely this override that separates the investors who build lasting wealth from the leveraged traders who experience a brief, thrilling ride followed by a sudden, spectacular crash. They are slaves to hyperbolic discounting, while Buffett is its master. To internalize this lesson and apply it to our own investment strategy, we can use a mental model called the compounding clock. This isn't just a thought experiment. It's a practical exercise you should do with your own numbers. It will vividly illustrate the catastrophic cost of being forced out of the market. Step 1. Calculate your future. Open a spreadsheet. In one cell, put your current investable portfolio amount. Let's say it's $150,000. Now, in the cells below, project its value forward for the next 30 years, assuming a conservative, long-term average annual return, say 8%. You will see the numbers start to grow slowly at first and then accelerate dramatically. After 10 years, your $150,000 becomes about $324,000. After 20 years, it's over $700,000. And after 30 years, it's nearly $1.5 million. This is your compounding clock. This is the beautiful, powerful engine that is working for you every single day, as long as you leave it running. This is your base case for achieving true financial independence. Step 2. Introduce the leverage shock. Now, let's imagine that in year 3 of your journey, when your portfolio has grown to about $190,000, you get impatient. You decide to use leverage to speed things up. You borrow an additional $100,000 and invest it. A severe market correction hits, not unlike the one in Tom's story from our previous chapter. A margin call cascade ensues, and your portfolio is wiped out. Let's be generous and say you're left with just $20,000 of your original capital. Step 3. Reset the clock. Now go back to your spreadsheet. Your new starting point in year 4 is not the $205,000 it would have been. It's $20,000. Start the 8% compounding calculation again from this new, lower base. Where are you after 30 years total? That reset clock, starting from $20,000, will grow to only about $186,000 by the time your original 30-year journey is over. Compare the two outcomes. On one hand, $1.5 million. On the other, $186,000. The difference is more than just money. It's a completely different life. It's the difference between a comfortable retirement and a struggle to make ends meet. That single leverage-induced event didn't just cause a loss. It murdered your future. It shattered the compounding clock and reset your decades of hard work and savings back to the starting line. When you visualize this, when you see the two curves on a chart, one soaring exponentially, the other plummeting to near zero and starting a pathetic flat crawl from the bottom, the seduction of leverage instantly vanishes. You realize that the single most important variable in your investment success is not picking the hottest stock or maximizing your annual return. It's maximizing the amount of uninterrupted time your money is allowed to compound. The antithesis to this patient, time-honored approach is the get-rich-quick mindset that has become a cultural pandemic. This is the path of the 99% in the modern digital age. It's fueled by a constant stream of social media posts showcasing Lamborghinis, luxury watches, and lavish vacations, all supposedly funded by a few lucky trades in crypto, meme stocks, or complex options strategies. The narrative is always the same. I cracked the code, I found the shortcut. You can too. This mindset is fundamentally toxic to the process of building durable long-term wealth because it glorifies outcomes while completely ignoring process and risk. A person infected with the get-rich-quick virus sees Buffett's approach as archaic and slow. Why would I wait 40 years to become a millionaire when this YouTuber says I can do it in 6 months? They see investing not as the ownership of productive businesses, but as a game of hitting jackpots. And in this game, leverage is not just a tool, it is the essential weapon. It is the only way to turn a small stake into a life-changing score fast enough to be worthy of an Instagram post. They engage in margin trading on volatile stocks, they use high-leverage crypto derivatives, they buy lottery ticket-like weekly options. For every one person who gets lucky and strikes it rich and then becomes the poster child for the scheme, there are thousands of others who are quietly and completely wiped out. Their stories are never told, their bankruptcies are not celebrated on TikTok. The get-rich-quick culture creates a massive survivorship bias, making the extraordinarily rare, lucky outcome seem like a plausible and repeatable strategy. It is a psychological trap, and leverage is the bait. It preys on our deepest insecurities, the fear of missing out, the desire for social status, and the powerful pull of hyperbolic discounting to lure people into a game that is mathematically rigged against their long-term survival. The direct financial connection here can be visualized as the broken compounding curve. Imagine a graph where the y-axis is your net worth and the x-axis is time. For a disciplined, unleveraged investor like Buffett, the curve starts out almost flat and then slowly, almost imperceptibly, begins to bend upwards, getting steeper and steeper until in the later years it goes almost vertical. This beautiful, sweeping J-curve is the physical manifestation of compound growth. Now, let's chart the path of the leveraged investor. Their curve is much more dramatic. It shoots up rapidly at the beginning, far steeper than the unleveraged investors. They feel brilliant. They are beating the market. They are on the fast track to wealth, but their path is not a smooth curve. It is a jagged line with a cliff at the end. At some point, they will encounter a period of volatility that their leverage cannot withstand. And at that moment, their curve does not just dip, it falls off the cliff, plummeting straight down to zero or close to it. Let's run a simple comparison. Investor A starts with $100,000 and earns a steady, unleveraged 8% per year for 30 years. Investor B also starts with $100,000. They use leverage to generate incredible 25% returns for the first 5 years. At the end of year 5, Investor A's portfolio is worth about $147,000. Investor B's portfolio, however, has soared to over $305,000. Investor B feels like a genius and pities poor, slow Investor A. But in year 6, Investor B gets caught in a market downdraft. Their leveraged bets go bad, they get a margin call, and they are completely wiped out, losing everything. They have to start over. For the next 24 years, let's assume they've learned their lesson and now invest their new savings, earning the same steady 8%. Meanwhile, Investor A just keeps chugging along, their curve getting steeper every year. At the end of the 30-year period, Investor B, despite their brilliant start, might have rebuilt a modest portfolio. But Investor A, the boring one, is sitting on over $1 million. The compounding curve was never broken. The engine was never shut off. The leveraged investor won a few sprints, but the unleveraged investor finished the marathon, and the prize for finishing is exponentially greater than the prize for leading the first lap. Leverage gives you a chance to get rich once. An unleveraged long-term approach gives you a chance to stay rich forever. There is a concept in mathematics and physics that is critically important for understanding risk, yet almost entirely absent from mainstream financial education. It is the idea of ruin. Ruin is not just a very large loss. A 50% drawdown in your portfolio is painful, but it is not ruin. You can recover from it. Ruin is different. Ruin is an absorbing barrier. It is a loss from which there is no recovery. It is going to zero. It is being kicked out of the game, permanently. Warren Buffett's entire investment philosophy can be boiled down to a single imperative: avoid any behavior that has a non-zero chance of causing ruin. And the single most common behavior that introduces the risk of ruin into an otherwise sound investment strategy is the use of leverage. The perfect historical laboratory for studying the difference between a painful loss and absolute ruin is the stock market crash of October 19, 1987, a day that came to be known as Black Monday. In a single trading session, the Dow Jones Industrial Average plunged 508 points, a staggering 22.6% drop. It was, and remains, the largest one-day percentage loss in the history of the index. The speed and severity of the crash were breathtaking. It was driven by a new, poorly understood phenomenon called portfolio insurance, a computer-driven strategy that automatically sold stock futures as the market fell, creating a vicious, self-reinforcing downward spiral. Panic swept through global markets. Fortunes were vaporized in hours. In Omaha, Warren Buffett was watching. On that one day, his personal net worth, which was almost entirely tied up in Berkshire Hathaway stock, fell by over $340 million. Berkshire's stock price plummeted. He experienced a paper loss of staggering proportions. But what was his emotional state? Was he panicked? Was he terrified? By his own account, he was completely calm. He went to work, read the paper, and drank his usual cherry cokes. Why? Because while he had suffered a massive loss on paper, he was in absolutely no danger of ruin. Berkshire Hathaway was a fortress of a company with very little debt. His personal finances were unleveraged. No one could force him to sell his shares. He knew that the intrinsic value of the businesses Berkshire owned, See's Candies, the Buffalo News, Geico, had not changed by 22.6% overnight. The price of the stock had become unmoored from the value of the businesses. Because he was solvent, he was able to view the crash not as a threat, but as an opportunity. The fear and panic of others were creating incredible bargains. He famously said, "The most common cause of low prices is pessimism, sometimes pervasive, sometimes specific to a company or industry. We want to do business in such an environment, not because we like pessimism, but because we like the prices it produces. It's optimism that is the enemy of the rational buyer." Black Monday was the peak of pessimism. While leveraged investors were getting margin calls and being forced to liquidate their holdings at fire sale prices, Buffett was calmly looking for things to buy. He was on the other side of the trade. The ruin of the leveraged became the opportunity of the unleveraged. This single day perfectly illustrates the profound asymmetry of risk. For the leveraged investor, a market crash is a terminal event. For the unleveraged, long-term investor, it is simply a temporary markdown and a potential buying opportunity. The psychological drivers behind this divergence in behavior are loss aversion and its nasty cousin, the disposition effect. Loss aversion is one of the most well-documented biases in behavioral economics, first identified by Daniel Kahneman and Amos Tversky. It describes the simple fact that for most humans, the psychological pain of losing a certain amount of money is roughly twice as powerful as the pleasure of gaining the same amount. Losing $100 feels as bad as winning $200 feels good. This is why we are fundamentally risk-averse creatures. When you are in a leveraged position and it starts to go against you, loss aversion kicks into overdrive. The amplified losses create an amplified psychological pain. A 10% drop in the stock feels like a 20% or 30% drop in your personal capital, and the emotional pain is magnified accordingly. This intense pain triggers a fight-or-flight response. Your rational, analytical brain, the prefrontal cortex, begins to shut down, and your emotional, primitive brain, the amygdala, takes over. This is what leads to panic selling. You sell not because your investment thesis has changed, but simply to make the unbearable pain stop. Now consider the disposition effect. This is the observed tendency of investors to sell assets that have increased in value, the winners, too early, while holding on to assets that have dropped in value, the losers, for too long. We sell winners to lock in the pleasure of a gain, and we hold losers in the hope of breaking even, to avoid the pain of realizing a loss. A margin call creates a horrifying inversion of this effect. When your broker demands you sell assets to meet a call, you don't get to choose which ones to sell based on your long-term outlook. You are forced to sell whatever is necessary to raise cash, which often means selling your highest quality, most liquid assets, your winners, because they are the easiest to offload. You are forced to sell your good companies to cover the losses on your bad speculative bets. Leverage hijacks your decision-making process, compelling you to do the exact opposite of what a rational, intelligent investor should do. Sell your best assets at the worst possible prices. To protect ourselves from this destructive asymmetry, we can adopt a powerful mental model popularized by the philosopher and risk analyst Nassim Nicholas Taleb, the barbell strategy. While Taleb's overall philosophy differs from Buffett's in many ways, this particular model is a perfect blueprint for avoiding ruin while still allowing for upside. Imagine a barbell used for weightlifting. It has a long bar in the middle, with all the heavy weights concentrated on the two ends. The barbell strategy suggests structuring your financial life in the same way. On one end of the barbell, you place the vast majority of your capital, say 85 to 90%, in extremely safe, conservative assets. For an investor, this would be your core portfolio of unleveraged, high-quality stocks, index funds, and bonds. This is your fortress of solvency. This part of your portfolio is designed to be completely immune to ruin. It is your defense. It is the part of your portfolio that will grind out steady returns and benefit from long-term compounding. You never, ever expose this capital to leverage or speculative bets. On the other, far smaller end of the barbell, you place a tiny portion of your capital, the remaining 10 to 15%, in extremely speculative, high-risk, high-reward ventures. This is your offense. This could be angel investing in startups, a small allocation to cryptocurrencies, or even starting your own side business. This is money that you can afford to lose entirely. You go into these investments with the full expectation that the most likely outcome is a 100% loss. However, if one of these bets pays off, the upside could be 10x, 50x, or even 100x. The key to the barbell strategy is what is in the middle: nothing. You avoid the medium-risk investments, which are often where hidden catastrophic risks lie. You don't use leverage to juice the returns of your safe portfolio, because that takes your safe assets and exposes them to the risk of ruin, breaking the entire model. The barbell ensures your survival with one side of your portfolio, while giving you exposure to massive, game-changing upside with the other. It is a structure designed to be anti-fragile. It not only withstands shocks, but can actually benefit from them. If a market crash happens, your safe core is protected, and you might even use some of its cash to add to your high-risk bets at depressed prices. It is the ultimate strategic application of the never-go-to-zero rule. The antithesis of this prudent ruin avoidance strategy is what we can call the all-in fallacy. This is the mindset of the person who, either through ignorance or arrogance, concentrates their entire financial existence into a single, highly leveraged bet. We all know these stories. It's the real estate developer in 2006 who owned 15 houses, all financed with no money down, interest-only loans, convinced that prices could only go up. It's the day trader who takes their entire life savings and puts it on margin into a single biotech stock ahead of an FDA announcement. It's the entrepreneur who takes out a second mortgage on their family home to pour money into a struggling business. These people are not just taking a risk. They are playing a game of Russian roulette. They have structured their affairs in such a way that a single adverse event can lead to total and irreversible ruin. They have failed to distinguish between a risk that has a range of outcomes and a risk that has a single absorbing barrier of failure. The person playing the all-in strategy might be right 5 times in a row. They might look like a genius for a while, their wealth and confidence soaring. But they are doomed. Because if you play a game with even a small chance of ruin over and over again, it is a mathematical certainty that you will eventually hit that ruinous outcome. They have ignored the fundamental asymmetry of the universe. You can only be bankrupted once. This brings us to the profound financial and mathematical concept of ergodicity. This is a crucial idea that separates the way risk is viewed in theory versus how it is experienced in the real world. Imagine 2 scenarios. In scenario A, we take 100 people and have them each flip a coin once. If it's heads, they win 50% of their bet. If it's tails, they lose 40% of their bet. This is a favorable gamble. We would expect, on average, about 50 people to win and 50 to lose, and the group as a whole would come out ahead. This is called ensemble probability. We're looking at the average outcome of a group of people at a single point in time. Now consider scenario B. We take one person and have them flip the same coin 100 times in a row, with the same payout structure. This is time probability. We're looking at the outcome for a single person over a sequence of events. Will this person also come out ahead? The answer is almost certainly no. They will eventually go broke. Why? Because the sequence of wins and losses matters. A string of losses at the beginning can deplete their capital to a point where the 50% wins are no longer large enough to recover. A single bad run can lead to ruin. Investing is a time probability game. You are not one of 100 people playing the market for 1 year. You are one person playing the market for many years in a row. Therefore, you must be obsessed with avoiding any strategy that can lead to ruin, no matter how attractive its average expected return looks. Leverage is the classic example of a non-ergodic strategy. It may have a positive expected return on paper, but it introduces a non-zero probability of ruin. And if you introduce a probability of ruin into a time series game, and you play long enough, you will eventually hit it. Buffett's rule to never use leverage is, at its mathematical core, an intuitive understanding of ergodicity. He is structuring his financial life to ensure that he can stay in the game forever, knowing that as long as he is in the game, the favorable probabilities of owning great businesses will eventually work in his favor. He is not just avoiding risk, he is avoiding the one type of risk that makes the math of long-term success turn against you. To truly ascend to the highest levels of Buffett's thinking, we must move beyond just protecting a personal stock portfolio and begin to think like a capital allocator, a CEO of our own financial enterprise. The crucial concept at this level is the power of permanent capital. This is the idea that the nature of your capital, where it comes from, and what its terms are, is just as important as how you invest it. Leverage makes your capital temporary, fragile, and conditional. It belongs to someone else, and they can demand it back at the most inopportune time. Capital that you own outright, with no strings attached, is permanent. It is patient. It is powerful. And it is the ultimate tool for building an empire. There is no better story to illustrate this than the story of Berkshire Hathaway itself. In the mid-1960s, Warren Buffett's investment partnership began buying shares of a struggling New England textile manufacturer called Berkshire Hathaway. By all accounts, it was a terrible business. The American textile industry was in a terminal decline, facing overwhelming competition from overseas. A conventional investor, especially a leveraged one, would never touch such a business. Its prospects were bleak. But Buffett saw something different. He wasn't just buying a stock. He was buying control of a business that, while dying, was still generating a small but steady stream of cash. After a dispute with the company's management, Buffett ended up taking control of Berkshire Hathaway. Now, a leveraged investor who took over a failing business would be in a precarious position. The bank loans would have strict covenants demanding certain levels of profitability. As the textile business continued to decline, they would have breached those covenants, and the bank would have foreclosed, wiping them out. But Buffett was using his partnership's permanent, unleveraged capital. He had no bank breathing down his neck. He had time. He began to take the small profits that the dying textile looms were generating and, instead of reinvesting them into the failing textile business, he started allocating that capital elsewhere. His first major purchase using Berkshire's cash was in 1967 when he bought National Indemnity Company, an Omaha-based insurance firm. This was a stroke of genius. He quickly realized that insurance was a far better business than textiles. And it had a magical characteristic. Insurance companies collect premiums from customers up front and only pay out claims later. In the interim, they get to hold and invest that money for their own benefit. This pool of money is called float. Float is the ultimate form of capital. It's even better than permanent capital. It's capital that other people pay you to hold. It is, in essence, negative cost leverage. Over the next several decades, Buffett would use the ever-growing mountain of insurance float, combined with the profits from a portfolio of wholly owned businesses, to acquire masterpiece companies like See's Candies, The Washington Post, Coca-Cola, and Apple. The failing textile mill became the launchpad for the most successful investment vehicle in history. This entire story, the genesis of the Berkshire Empire, was only possible because his initial capital was permanent. It allowed him to be patient with a bad business long enough to drain its resources and redeploy them into wonderful businesses. Leverage would have made this masterstroke of capital allocation completely impossible. The psychological principle that reinforces the power of permanent capital is called the endowment effect. This is another well-established cognitive bias where we tend to overvalue things simply because we own them. If you give someone a coffee mug and then offered to buy it back from them, they will typically demand a much higher price than what they would have been willing to pay for it in the first place. Ownership itself creates a sense of value and attachment. When you own your assets outright, using your own permanent capital, the endowment effect works in your favor as a long-term investor. You feel a true sense of ownership over your shares of a company. You've done the research, you've committed your hard-earned savings, and you value them. This makes you psychologically reluctant to sell them at a cheap price during a market panic. You are more likely to hold on, to stick to your long-term plan. But when you own assets on margin, the psychological dynamic is completely inverted. You don't truly feel like the owner. You know consciously or subconsciously that your broker has the ultimate claim on those assets. They are not really yours, they are collateral. The endowment effect is shattered. You have no deep-seated conviction or sense of ownership because you know that your control is conditional. This makes it incredibly easy to panic and sell at the first sign of trouble. The lack of true ownership creates a psychological fragility that is just as dangerous as the financial fragility of the margin loan itself. Permanent capital endows you with a powerful psychological resilience that borrowed money can never provide. How can we apply this CEO-level mindset to our own lives, even if we aren't running a multi-billion-dollar conglomerate? We can build what I call the fortress balance sheet for our personal and professional lives. This mental model involves thinking of your entire financial existence, your career, your savings, your investments, your home, as a single integrated enterprise called You Inc., and managing its balance sheet with the same discipline Buffett applies to Berkshire. Step 1 is to minimize and control your liabilities. The biggest liability on most personal balance sheets is a mortgage. While a mortgage is a form of leverage, it is generally considered more acceptable because the asset, a house, is a long-term utility asset, not a speculative one, and the loan is typically long-term and fixed rate, without the threat of a margin call. However, the principle still applies. The less debt you have of any kind, mortgage, car loans, student loans, credit card debt, the stronger your fortress. Create a systematic plan to reduce and eliminate debt, turning every paid-off loan into another stone in your fortress wall. Step 2 is to maximize your permanent equity and build your financial ammunition. Your permanent equity is your net worth, your assets, minus your liabilities. Your primary focus should be on growing this number. Your financial ammunition is your cash and near-cash reserves. Just as Buffett keeps tens of billions of dollars in cash on Berkshire's balance sheet, you must maintain a significant cash position. This cash is not doing nothing. It is buying you something invaluable, optionality and peace of mind. It is the dry powder that allows you to survive a job loss without going into debt, and to take advantage of investment opportunities when markets are in turmoil. Step 3 is to think of your career as your primary cash-generating subsidiary. Your job is the seas candies of your personal enterprise. You must protect it, invest in it through skills and education, and ensure it produces a reliable stream of cash flow, your salary, that can be deployed into your investment portfolio. By viewing your financial life through this fortress balance sheet lens, you move away from a scattered, reactive approach to money and adopt a proactive, strategic, CEO mindset. Your goal is not just to get rich, but to build an enterprise that is resilient, enduring, and designed for long-term compounding. The antithesis to this disciplined fortress-building approach is the all-too-common story of the debt-fueled expansion. This is the path of the 99% of businesses and, tragically, many individuals. Consider a well-run small business, a restaurant for example. The owner is passionate, the food is great, and it's making a healthy profit. The business has very little debt. Then, the owner gets ambitious. They want to grow, to build an empire. They go to the bank and take out a massive loan to open 5 new locations at once. For a while things go well. Revenues multiply, and the owner feels like a mogul. But their balance sheet is now fragile. They have huge interest payments to make every month. Then, a mild recession hits. People eat out a little less often. The company's revenue dips by just 10 to 15%. In their previous unleveraged state, this would have been a minor issue. They would have tightened their belts and ridden it out. But now, that 15% dip in revenue is catastrophic. It means they can no longer meet their monthly debt service payments. They have violated the debt covenants in their loan agreement, the rules the bank sets that the business must follow. The bank panics and calls the loan. The business is forced into bankruptcy. Notice what happened here. The business did not fail because it was a bad business. It failed because its capital structure was fragile. It died not from a lack of profitability, but from a lack of liquidity and an excess of leverage. This exact same story plays out in individual lives every day. People who lose their jobs and then their homes because their personal balance sheets were too leveraged, with too little cash and too much debt. They built a beautiful enterprise on a foundation of sand. The direct financial connection here comes from the language of corporate finance, specifically debt covenants and the interest coverage ratio. These aren't just terms for Wall Street analysts. They are critical concepts for understanding the stability of any enterprise, including your own. A debt covenant is a clause in a loan agreement that requires the borrower to maintain certain financial metrics. For example, a bank might require a company's equity to always stay above a certain level. If it drops below, even due to a temporary market fluctuation, the bank can demand immediate repayment of the entire loan. This is the corporate equivalent of a margin call, and it is a primary cause of bankruptcies. A key metric that banks and smart investors look at is the interest coverage ratio. The formula is simple. You take a company's earnings before interest and taxes, EBIT, and divide it by its annual interest expense. A company that earns $1 million and has $100,000 in interest payments has an interest coverage ratio of 10. This is very healthy. It means their profits are 10 times larger than their interest obligations. They can suffer a massive drop in profitability and still easily pay their lenders. A company that earns $1 million and has $800,000 in interest payments has a ratio of 1.25. This is incredibly fragile. A small dip in profits could make it impossible for them to pay their interest, leading to default and bankruptcy. You can and should apply this to your own life. Calculate your personal interest coverage ratio. Take your monthly income before taxes and divide it by your total monthly interest payments on all your debts: mortgage, car, credit cards. The higher that number, the more resilient your personal financial enterprise is. A high ratio is a sign of a fortress balance sheet. A low ratio is a sign that you are living on the edge, vulnerable to the slightest financial tremor. By focusing on increasing this ratio, by either increasing your income or, more directly, by eliminating debt, you are making a direct, quantifiable improvement to your financial resilience. You are moving away from the fragile path of the 99% and onto the indestructible path of permanent capital. Ultimately, the most profound advantage of avoiding leverage is not financial but psychological. It is the ultimate arbitrage opportunity in a market filled with participants who are stressed, emotional, and prone to panic. By refusing to borrow, you purchase something that no amount of money can buy directly: sanity. You achieve a state of mental clarity and emotional equanimity that allows you to make rational long-term decisions, especially when everyone else is losing their minds. This clear-headedness is the final, and perhaps most powerful, competitive edge an investor can have. The ultimate case study for this principle is, without a doubt, the global financial crisis of 2008. It was a perfect storm, an inferno fueled by leverage on an unprecedented scale. Homeowners had been given mortgages with no money down. Banks had taken those mortgages, bundled them into complex securities, and then leveraged themselves 30 or 40 to 1 to buy more of them. The entire global financial system was a house of cards built on a mountain of debt. When U.S. house prices began to fall, the whole structure started to wobble, and then it collapsed. Lehman Brothers, a 158-year-old investment bank, went bankrupt. Bear Stearns was sold for pennies on the dollar. AIG, the world's largest insurer, had to be bailed out by the government. Panic was not just in the air, it was the only thing in the air. The stock market was in a free fall. The world felt like it was ending. And what was Warren Buffett doing? He was not panicking, he was not selling, he was shopping. He had two things that almost no one else in the world had at that moment: a mountain of cash and a clear head. Because Berkshire Hathaway was a fortress with virtually no debt, the market collapse was not a threat. It was the single greatest investment opportunity of his lifetime. He was the only person with the capital and the credibility to act as a lender of last resort to the system itself. In September 2008, at the height of the panic, he invested $5 billion in the investment bank Goldman Sachs. The terms were incredible. He received preferred stock that paid him a 10% dividend, $500 million a year in cash, and he also got warrants to buy Goldman common stock at a very low price in the future. A few weeks later, he made a similar $3 billion deal with General Electric. The next year, he would provide crucial financing to Bank of America. These were not just investments, they were acts of financial rescue that earned him and his shareholders billions of dollars. He was able to do this for one reason: his absolute, career-long discipline of avoiding leverage meant that he was perfectly positioned to take advantage of a crisis created by the leverage of others. He was, in his own famous words, being, quote, greedy when others are fearful. And his sanity, his ability to think rationally while the world burned, was a direct result of his unleveraged financial position. He could not have been that greedy or that brilliant if he had been even the slightest bit fearful about his own survival. The core psychological principle at work here is the phenomenon of cognitive tunneling under stress. This is a well-researched human response to acute, high-stakes threats. When you are faced with a situation that you perceive as life-threatening, and a margin call that threatens your entire life savings certainly qualifies, your brain undergoes a radical shift. The sympathetic nervous system kicks in, flooding your body with adrenaline and cortisol. Your field of vision narrows, your hearing becomes focused. And most importantly, your higher-level cognitive functions, which are handled by the prefrontal cortex, begin to go offline. You lose the ability to think creatively, to weigh multiple long-term outcomes, to engage in complex problem-solving. You tunnel in on the immediate threat and how to escape it. A leveraged investor staring at a screen flashing red is not a rational economic actor. They are a cornered animal. Their only instinct is to make the threat disappear, which usually means selling everything, right now, at any price. They are cognitively incapable of thinking. This is a temporary panic. The long-term value of my holdings is intact. Their brain has been hijacked by a primal fear response. Being unleveraged is the ultimate defense against this hijacking. Because a market crash holds no existential threat to you, your brain remains calm. Your prefrontal cortex stays online. You are able to step back, assess the big picture, and see the fear of others not as a contagion to be caught, but as an opportunity to be exploited. You retain your CEO mindset, your ability to make executive decisions while everyone else is running around like a terrified intern. This sanity is not a personality trait. It is a strategic asset that you build through a disciplined financial structure. We can translate this powerful concept into a final, actionable mental model, the anti-fragile investor framework. The term anti-fragile, coined by Nassim Taleb, describes things that don't just resist shocks and volatility, but actually gain from them. An unleveraged portfolio is robust. It can survive a crash. An anti-fragile portfolio is one that is structured to become stronger and more profitable because of a crash. Step 1 is to build your foundation of anti-fragility, which is your fortress balance sheet we've already discussed. Zero leverage and a large cash position. This is your defense. Your cash is not just a safety net, it is your weapon. Step 2 is to create your panic watch list. During calm market times, you do your homework. You identify a list of 10 to 15 truly wonderful businesses with durable competitive advantages that you would love to own for the long term. Companies with strong balance sheets, great brands, and consistent earnings power. Step 3 is to set your greed trigger prices. Next to each company on your watch list, you determine the price at which you believe it would be an absolute bargain, a price that you would only expect to see during a period of extreme market pessimism. This might be 30%, 40%, or even 50% below its current trading price. You write these prices down, you set alerts for them. Now you wait. You go about your life, letting your existing portfolio compound. When the next market panic inevitably arrives, and the world is gripped by fear, you will not be a deer in the headlights. You will be a hunter with a plan. Your phone will light up with alerts that your trigger prices have been hit. While others are experiencing cognitive tunneling and panic selling, you will experience a surge of excitement and clarity. This is the moment you have been preparing for. You can now deploy your cash, your financial ammunition, and buy shares in those wonderful businesses from the panicked sellers at prices you once only dreamed of. You are not just surviving the storm. You are using its energy to power your own long-term growth. You have structured your financial life to be anti-fragile. The antithesis, the path of the 99%, is the life of the emotional yo-yo. This is the leveraged investor whose psychological state is completely tethered to the daily fluctuations of the market. On days when the market is up, they feel euphoric, brilliant, invincible. They are checking their portfolio value every 10 minutes, high on the adrenaline of their amplified gains. They make rash, overconfident decisions to add even more leverage. On days when the market is down, they are plunged into a state of despair and anxiety. The amplified losses gnaw at their stomach, sleep becomes difficult. Every news headline feels like a personal attack. Their decision-making is no longer driven by logic or analysis, but by a desperate need to staunch the emotional bleeding. They are the ones who finally capitulate at the very bottom of a crash, selling everything not as a financial decision but as an act of psychological surrender. The pain is simply too much to bear any longer. They lock in their catastrophic losses forever, ensuring they miss the subsequent rebound. Their entire investment journey is a chaotic, exhausting, and ultimately destructive ride on a roller coaster of fear and greed. They are a puppet, and the market's daily whims are pulling the strings. The direct financial connection to this advantage of sanity is a concept known as the liquidity premium. In normal times, Cash is seen as a lazy asset, earning little to no return. But in times of crisis and panic, cash becomes the most valuable asset in the world. When leveraged players are all forced to sell at the same time, the supply of assets for sale overwhelms the supply of buyers. Prices collapse not because of a change in fundamental value, but because of a technical crisis of liquidity. In these moments, the person holding cash can demand a massive discount to take assets off the hands of the forced sellers. This discount is the liquidity premium. It is the fee you get paid for providing liquidity to a market that is desperate for it. Warren Buffett's deals with Goldman Sachs and Bank of America in 2008 were a masterclass in harvesting the liquidity premium. He was the only one with the cash and the stomach to provide it, so he could dictate the terms. The 10% dividend he received was not just a return on his capital. It was his payment for being the calm, sane, liquid player in a world of panicked, insane, and illiquid ones. By avoiding leverage your entire life, you are not just aiming to be a survivor of the next crisis. You are positioning yourself to become the provider of liquidity. You are transforming the market's greatest fear into your greatest financial opportunity. You are choosing to arbitrage the most valuable commodity in the financial universe, sanity itself. And so we arrive at the end of this deep exploration, but at the beginning of a profound transformation in how you view the world of money, risk, and wealth. You have spent this time not just learning a tip or a tactic, but absorbing a complete philosophy. You now understand the fundamental distinction, the bright line that separates the intelligent investor who succeeds from the intelligent investor who goes broke. It is not about IQ. It is not about having a more complex spreadsheet or a better algorithm. It is about a single, unwavering commitment to never, ever allowing anyone or anything to force you out of the game. You have acquired the mental armor of absolute solvency, the understanding that avoiding ruin is the only strategy that matters, because it is the only strategy that guarantees you have the time for all the other strategies to work. But this powerful principle of survival, as critical as it is only the foundation. It is the bulletproof bunker from which you will operate. Knowing how to never get wiped out is the essential first step. But the next question becomes infinitely more exciting. What do you do with this indestructibility? How do you go on the offensive from this position of absolute security? Building the fortress is how you survive the war. Knowing which assets to buy and when is how you actually win it. The principle we have mastered today is the how not to lose. The next piece of the puzzle is how to win. This is the nature of a true system of thought. Each principle is a load-bearing pillar, connected to all the others. The rule against leverage is the foundation, but it is not the whole cathedral. The video that is now appearing on your screen is designed to be the next part of that structure. It is the link that connects the principle of survival to the engine of portfolio growth. It bridges the gap between risk management and wealth creation. Think of what you have learned today as the map of the treacherous coastline, showing you all the rocks and reefs where others have wrecked their ships. The next video is the compass that will guide you across the open ocean toward the shores of true financial freedom. Many people will watch this and feel relieved that they now know how to avoid catastrophe, and that is a valuable lesson. But a select few, those with the mindset of a true capital allocator, will feel a sense of impatience. They will feel the urge to not just protect their capital, but to intelligently and aggressively deploy it. The choice to click is more than just a choice to watch another video. It is a declaration of your intent. It is the choice to move from being merely an intelligent investor to becoming the CEO of your own financial destiny. It is the choice to continue your ascent. Complete your mental arsenal. The next piece of the map is waiting for you. Click. And let's continue building.